Picture this. It is late at night. The house is quiet. You are staring at your brokerage account and you have that sinking feeling in your stomach, the one that tells you something is fundamentally broken. You did everything right. You read the books, you listened to the podcasts, maybe you even hired one of those advisors in a nice suit who charges you 1% a year to play golf. They all told you the same thing. Just put 60% of your money in stocks for growth and 40% in bonds for safety. It's the golden rule. The bonds are your ballast. They are your safety net for when the world gets scary. And then 2022 happened. You pulled the lever on your safety net, expecting it to cushion the blow of the stock market crash. But instead of cushioning you, the safety net turned into an anchor. You saw something that wasn't supposed to happen. You saw both stocks and bonds free falling together. It was the first time in decades that both engines of your portfolio failed at the exact same time. If that felt like a punch in the gut, I have good news and bad news. The good news is, it's not your fault. You aren't crazy, and you didn't pick the wrong stocks. The bad news is, you were operating on a manual written for a world that no longer exists. The 60-40 portfolio isn't just struggling, it died. The financial industry is trying to weekend at Bernie's this corpse because they don't know what else to sell you. They are terrified to admit that the old models are broken. My name is Alex. I spend way too much time thinking about portfolio construction and macroeconomics so you don't have to. If you want to survive the next decade of investing without losing your shirt, hit that subscribe button right now. We are going to fix your portfolio today. Here's the plan. We are performing an autopsy. I'm going to show you the math on exactly why the 60-40 failed, the psychology of why you're scared to ditch it, and the new 4-pillar framework you need to build. Let's start with the history, because if you don't understand where we've been, you'll never understand where we're going. The 60-40 rule became popular during a very specific anomaly in history, the Great Moderation. Since 1981, we have been riding a 40-year wave of falling interest rates. Here is the math most people miss. Bonds are mathematically inverse to interest rates. When interest rates fall, the price of existing bonds must go up. It's gravity. For 4 decades, investing was easy mode. Stocks went up because money got cheaper. Bonds went up because rates kept falling. You could be a terrible investor and still make money. The strategy relied on negative correlation. The idea was, when stocks crash, investors panic and rush into bonds. The Fed cuts rates to save the market. Bond prices soar. This worked perfectly in 2008. It worked in 2020. In a deflationary crash, bonds are your insurance policy. They zag when the market zigs. But here's where it gets really interesting. That relationship relies on low inflation. When inflation shows up, the rules of physics change. In 2022, inflation hit 9%. The Fed couldn't cut rates to save your portfolio. They had to raise rates to kill inflation. This flipped the game board. This introduced duration risk. Most people don't know what this is, but it's the reason you lost money in your safe assets. Think of a bond like a seesaw. A 30-year bond is a very long seesaw. If rates move up just a tiny bit, say 1%, the price of that bond crashes by 10% or 15%. So you bought that safe, long-term treasury ETF. But mathematically, because rates rose so fast from zero, it had the volatility of a tech stock crash. And for what? Even today, with rates higher, after you subtract inflation, your real return on bonds is barely positive. You are essentially picking up pennies in front of a steamroller. You are taking massive interest rate risk for a coupon that barely buys you a sandwich. The 60-40 is like driving a car looking only in the rearview mirror. It works fine on a straight highway, but the road just turned and we are heading off a cliff. So why is your advisor still pushing this? Why do target date funds still do this? Reason number 1, career risk. It is much safer for an advisor to lose your money in the same way everyone else is losing money. If they fail with the herd, they blame the market. But if they try something different, like the portfolio I'm about to show you, and it underperforms for even 1 quarter, you fire them. So they stick to the broken model. Reason number 2, psychology. Stocks and bonds feels like meat and potatoes. It feels wholesome. Real diversification feels weird. You think you're diversified because you own 500 stocks, but they all rely on the same liquidity. When the liquidity wire is cut, they all fall together. Okay, enough doom and gloom. Let's fix it. We need a paradigm shift. We need to move from a 2-pillar portfolio to a 4-pillar portfolio. And these pillars need to hate each other. We want them to move independently. Pillar 1 is true growth. This is still stocks. We aren't abandoning capitalism. It's the greatest wealth generator in history. But for crying out loud, stop betting 100% on the S&P 500. The US had an incredible decade, but valuations are sky high. Look at global value stocks. The rest of the world is on sale. If the US dollar weakens, international stocks are your hedge. You need a passport for your money. Pillar 2 is inflation hedges. This is the missing link. This is what the 60-40 completely ignores. We are talking tangible things: energy, industrial metals, agriculture, things that hurt when you drop them on your foot. And we are talking gold. Gold isn't an investment. It is insurance against central bankers making mistakes. It has survived every empire for 5,000 years. In the stagflation of the 1970s, a standard stock portfolio lost value for a decade. Commodities were the only thing that kept families from going broke. Pillar 3 is where it gets uncomfortable but powerful. Uncorrelated assets. Specifically, we are looking at strategies like managed futures or trend following. These are computer models that track trends in hundreds of global markets: currencies, bonds, soybeans, oil. They don't care about fundamentals. They care about price. The magic is they can go short. They make money when prices fall. When bonds crashed in 2022, managed futures shorted bonds and made a fortune. We call this crisis alpha. It is the fire extinguisher that actually works when the house is burning down. Finally, pillar 4, the new safety. This used to be long-term bonds. Not anymore. Forget the 30-year bonds. The risk-reward ratio is broken. Right now, safety is cash and short-term T-bills. The yield curve is inverted. You can get 5% yields with zero price risk. Why reach for yield in dangerous places when the bank is paying you to be safe? Cash pays you to wait. It gives you optionality. It gives you the power to buy distressed assets when everyone else is panic selling. So, what does this look like in practice? A balanced, all-weather portfolio might look like 25% in each of these buckets. The goal isn't to beat the S&P 500 in a bull market. The goal is to survive the bear market so you don't sell at the bottom. Now, I hear you screaming, "Alex, I can't trade soybean futures. I have a job. This sounds expensive." Good news. We live in the golden age of the retail investor. The barriers have collapsed. You can now buy these strategies via ETFs. You can buy a managed futures strategy with a single ticker symbol, just like you buy Apple stock. You can buy a commodity basket with one click. Objection number 2. But Alex, stocks always recover eventually. Why bother with all this? Eventually is a very long time. Are you old enough to remember the period from 2000 to 2013? The S&P 500 had a 0% return for 13 years if you adjust for inflation. That is a lost decade. If you retired in 2000 with a 100% stock portfolio, you ran out of money. You don't have an infinite time horizon. The secret sauce here is rebalancing. This is how you make the magic happen. When commodities spike and stocks crash, you sell the expensive commodities to buy the cheap stocks. You are systematically forcing yourself to buy low and sell high. This removes the emotion. You aren't guessing. You are just managing the machine. Most investors lose money because they panic. This system harnesses volatility instead of fearing it. Here is the bottom line. The 60-40 rule is a relic. Sticking to it now isn't conservative investing, it's laziness. You can invest based on hope, hoping the last 40 years repeat, or you can invest based on math and structural balance. The 60/40 is a candle melting in a high heat environment. It wasn't built for this inflation. The 4-pillar portfolio is a fortress designed for any weather: sun, rain, inflation, deflation. Don't let advisor complacency or your own desire for simplicity wreck your financial future. Look at your portfolio. If it's just stocks and bonds, grab the wrench and fix it. If this video woke you up a little bit, destroy that like button so the algorithm shows this to more people who need to hear it. Subscribe if you want more unfiltered financial truth. I'm Alex. Thanks for watching. Now go do your homework.